Hey guys, it's Henry. In this video, I want to discuss the 3 best wheel strategy stocks that you can implement the wheel strategy on. I'm going to be giving you the secret to find the best stocks for the wheel strategy to run it profitably. And I'm going to be specifically discussing which stocks I like the most from my personal list and why I like those stocks right now. As a reminder, I have a Discord community where you can follow my trades. You can get access to me all market hours. You can see everything that I'm buying and selling, get access to my coaches, a full course, a community, and much more by accessing the first link in the description and booking a free call to discuss if it's a good fit for you. Now, let's discuss the wheel strategy. This is literally my favorite strategy. I have been using the wheel strategy for a very long time. I've grown my account over $2 million. And a lot of this gains is actually from using the wheel strategy because it's pretty much the safest and most consistent way to make consistent cash flow. Now, it's really important to look at stock selection because stock selection is one of the most important criteria for the wheel strategy. And honestly, if you buy a bad stock, you will get bad results. If you buy a good stock, you don't even have to pick the best strike price, you're going to get good results. So it really is about picking the right stock. And then after that, there are certain criteria that I really do look for, such as volume, open interest, implied volatility, and strong long-term fundamentals of the stock. Starting off with number 1 is volume. I mean, you really need to understand volume on a pretty good level because if, volume is like 2 or 3, well, that's not going to be good. You're not going to be able to be filled on your position. And generally, I would say the higher the volume, the more liquidity. And the more liquidity, the better. Let me show you an example. So if I pull up NEO in my portfolio and I just show an example, if I go to trade NEO options, and let's say I'm going to sell a put option for the expiration day of, let's just say March 10th. If you're watching this in the future, by the way, this video is going to be applicable to you anytime in the future because I'm just showing you how I think about trading options. And if you copy the same logic, you're going to have very good results, or at least you're going to become a much more profitable trader. Now, I'm going to expand the $10 put right here, take a look at the delta, take a look at the volume and the open interest. Because if I go back to my presentation, you'll see here that volume and open interest are very, very important. Now, specifically looking at the volume, there is 49 here. That's not bad, but that's also not fantastic. As you can see, the bid is 68 cents and the ask is 76 cents. That's not too bad, but the gap here is going to be 8 cents, or because each option is 100 shares, it's going to be $8. $8 isn't too bad, but just so you do know, whenever you do open up this trade, you're basically losing, about $8, but you're probably going to fall in the between, which is like $4. So you're going to lose $4, okay? Now, that's not that big of a deal if you think about it on the surface, but it becomes a very big deal, especially if you're trading spreads. But, even if you're not trading spreads and you're just doing the wheel strategy, it's still $4. And $4 might not seem like a lot, but $4 divided by 68 is actually a pretty big chunk and almost 10% of the value of the premium that you're collecting. So although you might not have any trading costs depending on which brokerage that you're using, you're still incurring some type of expense. And that expense can be lowered if the volume is higher. Because if you look at Apple, for example, Apple's volume is huge and the bid and the ask only have a difference of typically $1. Now, if you look at the open interest, you also want to make sure there's enough open interest because that's also going to affect the liquidity. And when I say liquidity, again, I'm talking about the difference between the bid and the ask. If you have a tight bid-ask spread, you're going to lose way less money when you trade. It's also going to cost you less in terms of the long-term return potential that you have because every time you're paying $4, if you do this, 10 times a week, that's $40 that you are kind of missing out on. All right, so now we discussed volume and we discussed open interest. You want both of them to be high. Next is implied volatility. Now for me, 30 to 60 is pretty high. But listen, you also don't really want it to be too high because too high is not necessarily a good thing. Let me explain. So going back to NEO, you can see that between 30 to 60 is good. NEO is currently at 80. That's fine. I do follow NEO stock pretty heavily. It is obviously having a high implied volatility because there's a lot of risks out there in China. However, 80 is not too bad either. If you look at a stock that has 120% volatility, you might be kind of salivating. You might be like, oh my gosh, there's so much premium here that I can sell. If I run the wheel strategy here, I'll get rich. Well, the thing is, not necessarily, because a stock that has 120% implied volatility is sometimes very dangerous. In fact, I'm using sometimes loosely. I would just say it is very dangerous because the only stocks that are above 100 are typically the really risky meme stocks such as AMC and GameStop, or it might be a biopharmaceutical company that has an FDA approval coming up and investors are not sure if it's going to be approved or if it's not going to be approved. Typically, those really risky biotech and healthcare companies are going to have very high implied volatility. They're going to have low volume, low open interest, and very bad liquidity. So that's exactly what I would not trade with the wheel strategy. What I would trade, and I'll get to that in just a minute, I'm going to show you 3 stocks that I would be doing the wheel strategy on, would be the big liquidity stocks. Now, before I get into stocks, I quickly want to discuss the strong long-term fundamental outlook, which is really important for me to look at, okay? I really look at a strong fundamental outlook because remember, when you are doing the wheel strategy, your real goal is when you sell a put option, yes, you collect premium, you're happy to keep that premium, but honestly with the wheel strategy, you are going to eventually get put on the stock. And when you get put on the stock, you ideally want to own that stock. You like it. You don't mind getting put. Therefore, the wheel strategy is pretty much risk-free if you want to own the stock anyways, but you get paid to buy a stock that you like at the right price that you get to pick because you picked the strike price. So how do I even pick a stock that I like? Well, there's actually a very long conversation we can go to, but I'm going to summarize it really, really fast here for you in this YouTube video because I'm always looking to give you a lot of value. And if you appreciate me giving you value, I always love it when you smash that like button. It really helps out my channel. All right, talking about fundamentals, okay? I really like to look at financial performance. How is this stock doing financially, okay? That's why I don't always like stocks that don't have earnings. I don't like assets that don't have earnings, such as crypto, okay? I really want to analyze what is a stock making? What is the revenue, okay? What is the earnings of that company? Are they actually taking home earnings? Because there is a lot of stocks out there that make a lot of money on paper and revenue, but they bring nothing home. And we've recently seen that with Lyft, okay? They have good revenue, but everything that they pay other people, no earnings, okay? Very, very low earnings. And that's why the stock was recently down 36%. But you don't have to look at Lyft. You can literally look at any stock. Whenever a stock misses earnings, clearly investors are upset and the stock goes down. And that's because Wall Street, very intelligent and educated people, are looking at revenue and earnings and other financial metrics to assess the current financial health. And more importantly, I think this is even more important, the future growth potential. And that's why Tesla was trading at like 1,000 price to earnings ratio, is because it had a lot of future growth potential many years back, right? That stock was really expensive, and that's because people were predicting very high future growth. So the value of a company is today, what is it bringing in revenue, earnings, what kind of cash does it have on its balance sheet, and then also lots of future growth potential. The next thing that I look for when I'm running the wheel strategy is really looking at a competitive advantage. Does this company have a huge market share, right? Is it actually dominating? Does it have brand strength? And when I think about brand strength, I really look at a company's overall health, like where are they going? For example, if I look at Apple, they're known for their innovative technology, including obviously the iPhone, its Mac products, as well as the software offerings such as iOS and macOS. I want to make sure that the company is having good, solid projections for where they're going. I want to make sure that sales are going up, and I want to make sure that the product is good. Are iPhones being sold? And obviously they are. Almost everyone has an iPhone. Next, if I also think about brand strength, I'll think about like Microsoft. Microsoft is a dominant player in the technology industry with really popular products. Like obviously a lot of us use Windows, Office, and they even have like video games like Xbox. The company is also investing very heavily in cloud computing and artificial intelligence. We just recently saw that with ChatGPT. So with Microsoft aiming for ChatGPT, I think that's going to be a game changer. And when I think about brand strength, Microsoft really comes to mind, along with, of course, Amazon. Amazon's like one of the biggest e-commerce companies in the world. They also have things like Amazon Web Services, which is a very high margin business. And just along with all the other tech stocks, like that's why I love tech, okay? They really have a lot of brand strength. They have market share. And companies like Google, they're a technology giant, search engine. They completely dominate search. But they also have other products and services such as Gmail, Google Maps, and Google Drive. All of these services are huge brand awareness for many customers out there. And having a technology advantage is a very good thing that I look for because that's going to give us stock stability. It's impossible for a company like Google to go bankrupt. I mean, it's almost impossible. Nothing can really happen for the company to go out of business. They have way too much of a foothold on the market they're competing in. So I really want to look at a company's ability to generate long-term sustainable profits. And that's because I have a degree in finance and my education taught me that, very similar to Warren Buffett, I want to make sure that a company has stable profits, strong brand. That way, nobody can just come in and outcompete them and put them out of business. Next, if I'm running the wheel strategy, I want to make sure that the company has not too much debt. I want to make sure that the company has liquidity and that it can actually pay its debts. It can actually run its operations. It can actually weather some bad economic storms. So that is also something that I really look out for. And then last, I also look at valuation. Okay, so valuation is super important because it's kind of like buying a house. If you buy a house that you are planning to rent out for and the house costs $100,000, you might be thinking, well, that's great, it's $100,000. But what if I told you that the earnings on the house for whatever reason were $100 a month? Well, that would be a terrible, terrible investment. Now, the reasons why it would be $100 a month could be various. Maybe the electricity costs are too much. Maybe it requires too much repairs. Maybe there's too much taxes, etc. Right? Price to sales is very similar to price to earnings, except price to sales is actually something that I really love to use for technology stocks. Price to sales really normalizes a company that is not making a lot of earnings, okay? Because a lot of companies, they have negative earnings, right? They're not making money yet because they're in the tech space. And if you look at price to earnings, it's going to be zero, non-existent, NA, or negative, right? Whatever, all of those are the same, right? It's not going to have positive earnings. But if you look at Tesla, if they make, say, $1 billion and they're worth 10 billion, well, that's pretty easy. The price is 10 to 1, okay? So the price is 10, the sales is 1, so the price of sales is 10. So it's really easy. It's really easy to normalize and compare price to sales ratios. There's also price to book ratios and other metrics to determine whether the stock is fairly priced relative to its earnings and growth potential. Again, if you want to learn more about stuff like this, then you should join my Discord community. This is where I go live and actually discuss stocks fundamentals, their technicals. And then I trade and I tell you exactly why I'm trading and which stocks I'm trading, what strike prices, everything that I'm doing for myself live. Best thing that you can ever do for your education. Again, it's a free call that you can book below. All right, and then I also like momentum. I do use OptionsFi as a stock picker and screener to get ideas, and I really like it because they use momentum as a factor. So if I'm going to start selling put options, then I'm going to check out this website, basically sell puts. And again, they have Google, Activision's pretty interesting. I actually really like Activision. They are a gaming company. I did my research on them when I was back at Drexel University in college, and I was a finance major. I was researching this company because I was very heavily researching stocks in the esports space. But one thing I really look for is momentum. Is momentum going in a positive direction, a negative direction, and by how much? Because basically, when I was working at a hedge fund, I realized that momentum is a very strong factor. I never really thought that it could be so strong, but honestly, if you look at a lot of models out there, like financial models, momentum is typically one of the main factors in almost every trader's toolkit. And that's because it is really shown that a good positive momentum is likely to continue, and then a weak negative momentum is also likely to continue. So if a stock is really, really depressed and has hit pretty much rock bottom and then it's starting to recover and it's showing signs of recovery, then that is a very good stock to start running the wheel on. But if a stock just started crashing and there is no end in sight and just a straight line down, you don't really want to start running the wheel strategy just yet. Okay, and then when I talk about the wheel strategy, which I'm going to get into, the first stock is going to be Oatly. I want to just basically tell you that you really want to be varying sectors that you are investing in. Okay, you want to vary sectors for extra diversification. Okay, this is very, very important. It is far too common. I see doctors, lawyers, very smart business people. They get into option trading, and then they get into my community, and then they start selling put options and running the wheel. They're like, great, I'm being safe, but they do 100% on Tesla. And I'm just kind of scratching my head because when they lose money, it's obvious. It's like you can't put all of your eggs in one basket. It doesn't matter what strategy you're running. There is no perfectly safe strategy to run 100% of your money on. That just does not make any sense at all. So I just want to caution you guys to do extra diversification. So in this video, I'm going to cover 3 stocks, but honestly, you should have more stocks. You can't just run 3 stocks in your portfolio and that's it, because 3 stocks could end up going down a significant amount. You really want to have varying sectors, okay? That means maybe you want to have some oil and gas like ExxonMobil. You want to have a little bit of healthcare. You want to have some consumer stocks like Starbucks and Nike. You want to have technology stocks like Google and Apple and Amazon and even Meta, right? You really want to diversify your holdings and have many different positions, okay? So please do that, because I'm looking out for your best interest for you not to blow up your money. So remember, you can also apply the same logic that you're learning in this video. I mean, this is literally a masterclass on, the wheel strategy. You can apply the same logic for different stocks as well. But let's start off with the first stock. The first stock is going to be Oatly. I really like Oatly for many reasons, and I'm also starting with the lowest price stock to help the small accounts out there. The stock right now is currently trending on the lower end near its $2 support. Now, Oatly is very favorable for small portfolios because the stock is around $2 per share. So if you want to get into the wheel strategy, you really only need $200. And when I look at the key fundamentals, they're looking pretty good to me. The company has decently growing revenues and basically checks out on a lot of fundamental metrics, okay? Now, when I also look at the fundamentals of the overall business and its competitive advantage, which we just recently talked about, it is a leader in its niche. It's a leader in oat milk. And a lot of people are actually converting from soy milk and almond milk and other milk alternatives to oat milk. I've looked at the oat milk market and it's really growing. So in terms of a competitive advantage, I like where the trend is going, and also Oatly, pretty much like its name suggests, is in the oat milk industry. So I really like that they're niche, okay? They're not gonna become a $1 trillion company. They're not gonna become an Apple, but the company can be a slow compounding growth winner in the long term, kind of like an Amex, right? If you look at American Express, they have a very loyal customer base. They're nowhere near as big as Visa or MasterCard, yet Warren Buffett owns Amex and he's been owning American Express for a very long time, and that stock is doing really well. It's consistently compounding over the long term. And I think something similar can happen to Oatly. It's not gonna have crazy high growth. It's not going to triple or quadruple or go up 10x, but I think it can have very consistent growth because it's gonna dominate in its industry. It doesn't really have too much competition, and if someone wanted to compete, sure, they could. It's not that hard to get on the shelves of Walmart if you're a bigger company, but still, Oatly has a good brand name. And then when I look at, the animal-free dairy products, they are becoming more popular. More people are going towards the, animal-free dairy stuff. So for me, I've done a lot of research into this, and that's why I think Oatly is a great stock to run the wheel strategy. And also has very strong distribution capacity. Oatly's specialty food service-led go-to-market strategy is increasing products and brand awareness, okay? And by forming alliances with all these coffee chains, they are really paving the way for international expansion. And specifically because they have a relationship with Starbucks. So Oatly has all of the baking, all of the ingredients. It's a full recipe for success in the long term. Now in the short term, I'm not sure what will happen, but that's why I'm saying I like the wheel strategy. And for me, selling the $2 put for a monthly expiration, March or June or even September, honestly, going out a few months to September, there's nothing wrong with that. I mean, if I go to Oatly right now, you will see that the return is actually very good. It's a very high return, even if you go out until September. And as you guys can see, I have 2,800 shares. It's a small position in my portfolio. Again, I believe in diversification, and that's why I don't have a large position here. But still, if you look at my option positions, I have a $2 put that's expiring. I have a $2.50 put that's literally expiring very, very soon. And then I have a $1 put that I have sold longer term. And actually, if I open this up right here, selling a put option is the first key or the first step to the wheel strategy. As you can see here, I am slightly up about $20 so far, and I'm very excited for this position because there's a very, very little chance that Oatly will be $1. But anyways, let's go to view all options, and I want to show you what selling a put will look like for June or even September. Let's just take a look at both of these options for Oatly. So if I look at starting the wheel strategy, let's go to June. And on June, it's 125 days away roughly. But again, if you're watching this in the future, you can always just sell a put option that's 1 to even 6 months out. There's nothing wrong with going a little bit farther out in terms of date. As you can see here, the $2 put is worth $35. That is a very, very big return in a very short amount of time as a percentage of what you're putting up. Now remember, a $2 put means you're putting up $200, but you're collecting $35, which means that you're only really betting $165 and you're making $35 on $165. That's a very big return. Now also let's look at the September 15 expiration. The $2 put is now going for $40 right here. If I expand this option, you will see that it does not have the ideal volume. It does not really have that great open interest. And its bid-ask spread is a little bit wide, but let me be honest, it's not that bad. Okay, it's $15, and that's why I do prefer to go a little bit farther in terms of date. Because look, if you trade this every week, yes, you are losing $7 a week. But if you trade this in 6 months, you're losing $7 in 6 months. That's like nothing. That's nothing at all. It doesn't even matter. So the implied volatility is 90, which is also very high. That's a good thing, you know? That's a good thing. If you like that stock, but the implied volatility is high, that means the premium is going to be higher. So this is a very good play. And for me, that's why I am saying that I am selling personally $2 puts on Oatly right now for all of these expiration dates, you know, February, March, June, and September. I am looking at all of these trades and I have plenty of Oatly currently open. All right, the next stock that I want to cover is going to be NIO. So NIO is a great stock right now. It's really, really sold off a lot. It's hovering around $10 per share as I'm making this video. And I've been looking at NIO for a very long time. I do like the EV space a lot. And you know, when I look at NIO, I really like that they're focusing on overseas expansion. NIO is positioning itself for long-term growth by expanding to overseas markets. With the recent agreement signed by CAT-L, NIO will be accelerating its overseas expansion. And for me, that means it's a growth stock, okay? That's just one metric I look for. Now, I don't just blindly pick growth stocks because that doesn't always mean that they are priced at a decent, you know, value. Sometimes growth stocks are super expensive and they can, you know, end up crashing and falling down a whole lot. So for me, I want to make sure that I am buying a growth stock at the right price. When I look at NIO, there's a lot that I like about the business, like battery as a service program, okay? So NIO's proprietary battery as a service program is being improved and scaled to help the company compete in the EV market. I really like this battery as a service program because it does reduce the upfront cost of ownership of a EV vehicle. If you're renting a battery, then it's not going to cost as much. However, over the long term, as you pay the battery and you get it serviced, that's going to make NIO some money. So I really like their model. Their business model is very interesting. And I also like the design of their new models. You know, if I look at NIO, NIO is designing new models that will compete at different price points in the EV market, which will help the company expand its customer base and increase its sales. You know, historically, it was pretty expensive, right? They're really expensive, but as they diversify into different price points, that is actually really good because we already talked about diversification. And even a company can obviously diversify within its own business unit. Like it can diversify within the market share that it has and start to have different price points. That's really smart, okay? So I don't want to make this video too long. I want to make sure I respect your guys' time. So let's get to the point. I'm going to be selling a $10 put for a weekly expiration on NIO. But also, if I look at NIO, I do want to own that stock. I want to own some of this stock, so I'm also doing a covered call strategy. And that's basically the wheel strategy right there. You sell puts, and once you get put, you start selling covered calls. So for me, selling puts at $10, and if you already have NIO, then you can also end up doing the 11 covered call on a weekly basis. For me, I really like to stick close to the money on NIO. I like to sell puts right under the current stock price, and as soon as I get put, then I run that wheel strategy and I start just selling covered calls right at basically a little bit higher than the stock price. And the third and final stock that I'm going to recommend is going to be Google. They recently lost $100 billion in market value on February 8th because its chatbot Bard ended up really messing up on a few questions that they were trying to compete with ChatGPT on, and they ended up failing pretty hard. So the company ended up falling $100 billion. And with basically $60 billion in annual earnings and $9 cash per share, I think that Google is very attractive after falling so much. I mean, yeah, they messed up, but in the long term, it's not gonna really matter. Google is still gonna figure it out, and Google is still going to keep making that money. So, Google has taken some heat for reporting a double miss in terms of sales and profits in the fourth quarter. But again, those misses are pretty minor, and they really don't reflect the overall picture of Google, because Google, again, is going to be its future cash flow, and they have so many projects on its books, and I think the search business is going to keep increasing. So for me, I'm very bullish, and I think that Google is a great company to do the wheel strategy on. And my general take on earnings releases is that, investors shouldn't really place too much value on them, okay? So again, Google did report bad earnings, but Google earned $1 per share versus $1.20. It's not that much of a miss. It's a 12.3% miss. But in the future, as soon as it beats, that stock is going to jump back up. So for me, if I can do the wheel strategy and sell puts, I'm very happy to get put Google. I have absolutely no problem. And in terms of the stock, I think it's kind of overreacted. It's overreacted a lot. It has fallen quite a bit. And honestly, any company that you find in the market that has fallen quite a bit, that is a high quality company, is a perfect candidate for running the wheel strategy. So for me, I do love doing the wheel strategy on Google, but if you have a smaller portfolio, one of the alternatives that you can do is actually a put credit spread. And I recently did a put credit spread that made me 33% return on Google, and I only put up $500. If you want to follow my small account challenge, where I'm just taking a small amount of money, like $5,000, and growing it into $10,000 or more using spreads, then make sure that you check out that first link in the description, watch my training, and see if you are a good fit for my Discord community. And if you want to learn more about put credit spreads, then you should watch this video right here on put credit spreads.